In this video, we will discuss other sources of information about companies. The goal is to help you learn where and how to obtain the information you need to make informed investment decisions. There is a lot to cover on this subject. We advise you to take notes and view it at least 2 times. Pick a company that interests you and then try what you've learned. Then view the video a 3rd time. You will absorb more once you are familiar with the material that is being discussed. We will start with the best known document, which is the annual report. That is a great place to begin to familiarize yourself with the company's business and how it is doing financially. Understand that it is management's report to investors, so it will present the company in the best light possible while being truthful and within reporting guidelines. Our goal is to help you become an effective reader of annual reports. Most investors are not. While annual reports are clearly prepared without any intent to deceive or reflect dishonesty about the business, we encourage you to read them thoughtfully and carefully. Your goal is to gain an understanding of the dynamics of the business and secure an understanding of where the opportunities and risks that the business is facing. This video is designed to teach you how to read between the lines and decipher the actual condition of the company. Typically, an annual report is accompanied by a 10-K report. The annual report is typically an impressive glossy paper document containing pictures and graphs, and it comes along with a letter from the chairman or CEO, along with an overview of the financials. By comparison, the 10-K is the black and white pictureless document that is submitted by the SEC. Sometimes, the business only produces the 10-K report. The 10-K is required of every public company. The annual report is not. And sometimes, they are combined into one document with the annual report providing narrative overview to the detailed financial reports in the 10-K section. Most investors feel the 10-K report is one of more significance, in spite of being longer and more tedious to read than the glossy annual report. Read both if available. The annual report provides a good overview of the business before tackling the 10-K filing. But if you're serious about investing, you must tackle that 10-K. If you're interested in learning more about and likely investing in a publicly traded company, you should examine both documents. Concentrate on the most important aspects of a company's 10-K filing. Doing this, you will avoid wasting unnecessary time on companies who do not meet your criteria for investment. But always keep in mind that your research time is not wasted, even if you later decide to not invest in that particular company. You have sharpened your researching skills and you have learned about a company and industry segment, which may lead you to a more promising investment opportunity. Investing is a discipline that rewards those people who are always learning new techniques and refining those they already know. The 10-K has a fairly set format to follow, and knowing that format will make your life far, far easier. The 10-K begins with a detailed description of the business, followed by risk factors and legal issues. You will find all the numbers and financial notes in the back of the 10-K, along with the management's discussion and analysis of the financial condition. This provides you their perspective and interpretation of the company's financial condition. The 10-K format includes the following sections: Business, a description of the company's operations. Risk factors. Legal proceedings. Elected financial data. Management's perspective and analysis of the financial condition. We encourage you to read the annual report of the 10-K report thoroughly. These will provide you the essential information about the business and its financial condition, along with the key risks and issues it is facing. Your goal is to become an effective trader of these documents, and you'll develop your own method of absorbing them that is effective for you. Begin with the business description. Clearly, it is essential that you understand the nature of the company's business. This will familiarize yourself with what the company does, its customers, and the industry in which it operates. I might add, for some of you, you might ask if you ethically agree with what the company does. For example, some people are averse to investing in weapons makers or livestock processors. If you do not understand and are comfortable with the basics of the company's business, then you are finished evaluating this company and it's time to move on to the next one. Next, skip over to items 6 and 7 and analyze the financial data. At first, this can seem a daunting task, but there are ways to make it easier, even for the novice financial analyst. Read with 2 questions in mind. 1. Has the company been trending steadily upward, or has it been erratic? And secondly, has the balance sheet gotten stronger or weaker over time? Do not overlook the cash flow statement, which reveals if the company's operations generate cash or if it consumes greater cash to sustain the operation. Sometimes businesses generate profits, but at the same time remain cash flow negative. Reflect on the income statement and the cash flow statement for any red flags, things that just don't seem logical to you. If you like what you see, continue, and if not, move on to the next company. Now that you have an understanding of the company's business and how it's doing financially, it is time to determine if any hidden surprises lurk beneath the surface. Go back and read the risk factors section and the legal proceedings section to determine if any issues are relevant to your investment decision. Read this risk factor section thoughtfully. You might see commentary about the industry, its competitors, pending governmental regulations, or other factors that could be a risk to the company's future growth or health. No business is completely without risk. You are looking for risk factors that seem unusual or concerning from an investor's point of view. Perhaps things such as having its business dependent upon just one product or one supplier, or dependent on just one or two customers. The sort of thing that if something happened to impact that product or one of those companies, the company would be in jeopardy. In addition, the legal proceedings section will alert you if any significant lawsuits are pending. To many companies, lawsuits and potential legal liabilities are a part of doing business and not out of the norm for them. You have to view it in context of how it might impact their business overall, and in context of their size. For example, a $20 million potential legal liability is rather minor to a $50 billion annual company. However, a potential patent infringement suit on the company's primary product is of paramount concern. It is all relative, so you are ready to gain an understanding of what a nature of the potential legal risks and how financially significant they would be if they occurred. The 10Q report is an abbreviated preliminary version of the 10K report. As the Q implies, it is issued quarterly. The 10K is an annual document. The 10Q is published quarterly to inform investors of financial results, news, and developments about the company, its businesses, and any significant events or plans. Thus, investors are kept abreast of how the company is doing as it moves through its year. The annual 10K will follow with more detailed and audited financial statements than what you will see in the 10Q. Major developments that investors should know about are described in the 10K or the 10Q. Sometimes news develops that is significant, but due to timing did not get included in the 10Q. The company reports these in an 8K report. This is just an interim report that the company files with the SEC to inform the government and investors of a major development since the last 10K. An 8K is issued if the news is profound and the material to the health of the company. Examples might include bankruptcy, an acquisition or sale of assets, or other events important to the investor. Proxy statements are another source of good information for the investor or potential investor. It is distributed prior to the annual shareholders meeting and must be preceded any shareholder vote on election of members to the board of directors or other corporate business. It details any items the management intends to bring for a vote in the upcoming shareholder meeting. It also reviews management's salaries, perks, and other information considered material to shareholders about the company's management. There are numerous forms that publicly traded companies file with the SEC. The most commonly used forms are the ones we just reviewed, the 10K, the 10Q, and the 8K. These can be viewed on Yahoo Finance. Enter the stock symbol, and up comes a page on that stock showing latest price and other data. On the left side of the page is a listing of other information available. Look down to that list of SEC forms. Click on that and you will see a listing of what is available. At the bottom of that list is a link that will take you to another list of available forms. This list will commonly show Forms 3, 4, and 5, which disclose ownership changes and purchases by company officers and members of the board of directors. Back at Yahoo Finance on the left side of the stocks page, you will also see links to a listing of the company's major competitors, a snapshot view of the industry in which the company competes, the company's major shareholders, the options and opinion of key stock analysts that follow the stock, and their expectations for future performance. As you explore the reports and documents we've just discussed, you will discover there is a vast amount of information readily available to you on any company that is publicly traded. This is available due to the SEC. Now, we've been talking about the SEC. The SEC is the Securities and Exchange Commission. You'll hear that a lot. The SEC was created in the 1930s as a regulatory watchdog to help stock manipulation and fraud. The SEC collects documents detailing the financial and operational health of domestic and foreign companies that have stock owned and traded by the public. It checks the quality of information provided in those forms to assure the information meets certain requirements. Many investors study the forms for clues they may offer, a quick assessment of the company's performance, or for a more insightful description of its activities. Sometimes you have to take extra care to read between the lines to fully comprehend the information submitted by the companies. You will gain a better view of the overall picture if you review SEC document and financial forms together rather than separately. A note about footnotes. Look for footnotes in the financial section of the annual report and the 10K report. Always read the footnotes. This is often where the bodies are buried. By that we mean footnotes often provide hints of information that is not covered in specific detail elsewhere, but it may be very important to you, the investor. Red flags are often waiting to be discovered in the footnotes, and like I earlier mentioned, they are required to show their business in a good light, but an honest and truthful light. There are important phrases that investors need to recognize as major red flags. Unfortunately, in filings made to the SEC, companies sometimes use arcane legal phrases to describe certain facts in an attempt to lessen their impact on their stock price in the market. This is a classic euphemism. You should learn and be alert to a few key phrases to help you understand what is really being said in these documents. One of these key phrases is material adverse effect. The words are used in SEC reports to inform investors that something is wrong or there is significant risk, and you need to thoroughly understand it. It can indicate a severe risk to the company's profitability and/or the responsibility and possibility that the company's financial position may be seriously compromised. For example, suppose there's one customer that represents a major percentage of the company's sales revenue, a big client. If the company were to lose that customer or client, it would have a material adverse impact on the company's health. That is the sort of risk that is disclosed in these documents that the company files with the SEC. The risk might reveal a major pending contract, or a risk due to an expiring line of credit agreement with their bank, etc. These and a variety of other risks could have a material adverse impact on the company's financial welfare, and some could even threaten its survival entirely. That is why you, the investor or potential investor, must read carefully and thoroughly these SEC documents the company has filed. They are for your protection as well as information.
To further illustrate, let's suppose you're considering buying stock of business X. While doing your research, you see the phrase that 3 customers account for 70% of the company's sales revenue, and that the loss of any one of these key customers would have, and here's the phrase, an adverse material effect on the company's revenue and profit. Another example might be alerting you that major patent litigation is pending, and this could have a material adverse effect on future sales and profitability. Another example might indicate the company is renegotiating a line of credit with their banks, and if unable to secure a renewal, it would create a material adverse effect on the company's ability to sustain operations to meet sales objectives. As you can see, the notice can be about many different things, but they all have in common the potential of creating a significant problem for the company. So be alert for the term, material adverse effect, as you read company reports and documents. Another phrase to be alert to is generally accepted accounting principles. Companies use this term to inform investors that they have chosen to exercise their flexibility in how they define and disclose a material adverse event. Financial statements are required to follow established accounting principles and practices to assure fairness and honesty. However, the accounting rules do allow some legal flexibility that many other companies use to manage earnings and place the company's performance in the best possible light. When they engage this practice of exercising their flexibility in how events are accounted for, they are required to notify you that they've employed some flexibility while still utilizing generally accepted accounting principles. So just be aware, and when you see this phrase, look for an explanation. sometimes in the footnotes to understand why it's being used and what it really means. From an investor's point of view, any piece of information is material if it is reasonable to expect that disclosure of that information will impact the company's current or future stock price. Corporate managers do strive to utilize techniques to report their operating results and what they feel is in a fair manner. But this can involve using their own definitions of what is material and what is not. Do not be overly concerned here. Most companies are honest and ethical. We merely bring these issues up to alert you that accounting practices do allow leeway in the way certain events and risks are portrayed. Therefore, read thoughtfully and with critical thinking. Be alert to arcane phrases, footnotes, anything that might be an attempt to obscure a fact that is important to your investment decision. We want you to be successful in your investing. Be especially alert to the phrase material adverse effect like I've mentioned. It may indicate a problem that will alter your view on this investment. It may alert you to an existing or future situation. Regardless, material adverse effect are profound words in an SEC document. When you see that phrase, stop, digest the situation, and think about its implications for the company and for your investment. It is the company's responsibility to alert you to what might be or might become a significant problem. It is your responsibility to interpret that risk in light of your investment goals. It is always up to you to decide. You may choose to learn more, watch the situation, or depart this company and move on to another company, maybe even a competitor. Once you are aware and understand the risk and how it affects your investment, you are in an empowered situation to prudently decide if this company is consistent with your investment plan and goals. You are, after all, executing an investment plan designed to help you achieve your goals. You need information to make your investment decisions, and that is what this video is about, acquiring the knowledge and information to make sound investment decisions to reach your goals. In conclusion, understand that the SEC wants investors to be informed, and therefore make informed investment decisions in light of these facts. Obtaining the available material and interpreting it correctly can provide any investor with valuable guidance when making investment decisions. You are investing your hard-earned money, so be diligent in your research. Successful investing comes from successfully obtaining and processing information. Dissecting every business detail in a company's financial statement is indeed difficult, so you must strive to find a balance between what you need to know to make your decisions and avoid burying yourself underneath reams of data, because that can be just as harmful. You're already on your way.